Your electricity bill rises. Your pension fund searches for higher returns. Somewhere else, a company signs a 10-year contract for computing power that barely existed 3 years ago. In 2025, Meta spent $72.22 billion on capital investment. Alphabet spent about $91 billion. The visible story is artificial intelligence. The hidden question is simpler. Who financed the machines before the profits arrived? Artificial intelligence sounds weightless. It is not. Every useful answer requires chips, servers, cooling systems, fiber, land, transformers, and electricity. The software may live in the cloud. The cloud lives inside industrial buildings. Those buildings can cost billions. They must be financed years before demand becomes certain. The AI boom is also a construction boom. Part of this expansion is straightforward. The largest technology companies generate enormous cash flows. They can buy servers and build data centers directly. That is not hidden debt. It is ordinary capital spending. But even the richest companies face a limit. Investors still judge free cash flow, margins, and returns. Building every facility on the corporate balance sheet can make those numbers look dramatically heavier. So the financing moves outward. A technology company can lease a data center instead of owning it. A developer can borrow against the building. A joint venture can hold the land, power equipment, and cooling systems. Private credit funds can supply loans that never trade on a public exchange. The infrastructure remains essential. The debt becomes less visible. Private credit is lending outside traditional bank loans and public bond markets. Asset managers raise money from pension funds, insurers, sovereign funds, and wealthy investors. They then make negotiated loans directly. The International Monetary Fund estimated that private credit reached about $2.1 trillion globally in 2023. That figure included invested assets and capital committed but not yet deployed. AI infrastructure has become a natural target. Data centers offer what long-term investors want: physical assets, contracted rent, large corporate customers, predictable payments, at least on paper. Technology companies want speed and financial flexibility. Infrastructure investors want long-duration income. Lenders want collateral and contractual protection. The match looks almost perfect until the assumptions change. The newest twist is the machine itself. Graphics processing units, or GPUs, are specialized chips used for large AI workloads. They are expensive, scarce, and productive. That makes them financeable. Loans can be secured by computing equipment, customer contracts, restricted cash, and claims on project assets. A chip designed for calculation becomes part of a credit structure. CoreWeave shows the model at industrial scale. The company says it primarily finances infrastructure through asset-level debt supported by take-or-pay customer contracts. Take-or-pay means the customer commits to pay for reserved capacity, whether it uses every unit or not. By the end of 2025, CoreWeave operated 43 data centers with more than 850 megawatts of active power. CoreWeave's revenue reached $5.1 billion in 2025. Its contracted backlog reached $66.8 billion. But total debt principal reached $21.615 billion. Net interest expense reached $1.229 billion. This does not prove the model will fail. It reveals the bargain. Rapid expansion is purchased with future customer payments, pledged assets, and very real financing costs. The lender is not merely betting on a pile of chips. The lender is betting on the customer contract behind them. If a major AI company promises to rent computing capacity for 5 years, that promise can support debt today. The expected revenue becomes financing capacity. The financing buys more GPUs. The new GPUs create more rentable capacity. The network expands through contracts. That cycle can be productive. It can also become circular. Chip makers invest in AI companies. AI companies sign cloud contracts. Cloud providers borrow to buy chips. Lenders value the loans partly because the contracts appear strong. Each layer validates the next. No single transaction must be improper for the system to become dependent on the same growth assumption. Demand must keep arriving. The largest cloud companies strengthen the entire structure because they look nearly impossible to replace. Their contracts can transform a speculative construction project into investment-grade infrastructure. But a strong tenant does not remove every risk. Contracts can contain milestones, performance conditions, renewal choices, and termination rights. A data center may last 20 years. The first technology cycle inside it may last far less. Meta's Hyperion project shows how far the structure has evolved. In October 2025, Meta and funds managed by Blue Owl formed a joint venture for a Louisiana data center campus. The estimated development cost was about $27 billion. Blue Owl-managed funds received 80% ownership. Meta retained 20% and agreed to lease the completed facilities. The phrase off-balance sheet sounds suspicious. It is not automatically deceptive. Accounting rules ask who controls an entity and who bears its economic risks. A joint venture may remain outside a company's consolidated balance sheet, while leases, guarantees, commitments, and ownership interests are disclosed elsewhere. The obligation is not invisible to careful readers. It is simply distributed across documents and entities. That distribution changes how the boom appears. The technology company reports lower direct ownership. The joint venture carries project assets. Investors contribute equity. Bondholders or private lenders provide debt. Lease payments arrive over time. The economic exposure still exists, but no single headline number captures the entire chain. Ownership is separated from dependency. A data center cannot earn money without electricity. This creates another financing layer. Utilities must build generation, substations, transmission lines, and grid connections. Developers may sign long-term power agreements. Local authorities may approve tax incentives. Equipment manufacturers expand factories. The AI balance sheet spreads into the energy system before the first model produces revenue. The International Energy Agency estimated that data centers used about 460 terawatt-hours of electricity globally in 2024. Its base case exceeds 1,000 terawatt-hours by 2030, more than double in 6 years. That forecast includes AI, conventional cloud services, and cryptocurrency. AI is a major accelerator, not the only source of demand. Software can be copied in seconds. Power infrastructure cannot. A new transformer may face long delivery times. Transmission projects require permits and construction. Generators need fuel, land, and grid access. Communities worry about water, noise, emissions, and electricity prices. The bottleneck moves from computing power to electrical power. Then finance follows the bottleneck. The answer depends on regulation and contract design. A data center may fund dedicated infrastructure directly. A utility may recover investment through long-term customer charges. Some costs may enter the wider rate base, which means ordinary electricity customers could share them. Regulators can require safeguards. There is no universal outcome, but the allocation decision matters enormously. AI hardware loses economic value quickly. New chips can offer more performance using less power. A server that is valuable today may become uncompetitive before the building around it is old. Accounting depreciation estimates that decline. Markets can move faster. If rental rates fall, yesterday's premium GPU cluster may support less debt than lenders expected. A warehouse can serve many tenants for decades. A specialized AI cluster is different. Its value depends on chip performance, software compatibility, energy efficiency, network design, and customer demand. Moving thousands of machines is expensive. Selling them during an industry downturn could push prices lower. The collateral is physical. Its value is technological. The central risk is not that AI produces no value. It already produces useful services and growing cloud revenue. The risk is timing. Infrastructure spending arrives first. Interest payments arrive on schedule. Lease payments continue. Electricity must be purchased, but AI revenue may grow more slowly, carry lower margins, or shift toward cheaper models. Debt does not wait for adoption. The technology company is betting that AI will strengthen its products and create new revenue. The infrastructure owner is betting that facilities remain occupied. The lender is betting that contracts and collateral protect repayment. The pension investor is betting that the credit fund priced those risks correctly. They are connected, but they are not making the same bet. If projected revenue disappoints, losses usually follow a hierarchy. Equity owners absorb the first decline in value. Junior lenders face the next layer. Senior secured lenders may take control of collateral. Tenants may still owe lease payments. Suppliers may lose orders. Workers may lose jobs. The risk travels through contracts, not headlines. Private credit funds often receive capital from pension plans and insurance companies seeking steady income. That does not mean retirees directly own a specific GPU loan. It means their institutions may have exposure through diversified funds. Higher yields can support retirement promises. Poor underwriting can weaken them. The distance between the saver and the server can hide the connection. Private credit is often described as replacing banks. The reality is more connected. Banks can provide credit lines to private funds. They can finance data center developers. They can arrange bonds, hedge interest rates, and lend against fund assets. Risk moves outside the traditional loan book, then reconnects through financing and derivatives. Shadow banking does not mean no banks. It means different plumbing. Now, the reality check. This financing exists because society wants infrastructure faster than corporate balance sheets alone can provide it. Private capital can spread risk across investors. Project finance can match long-lived assets with long-term payments. Leases can give customers flexibility. Contracted construction can create real productive capacity. Debt is not evidence of a bubble. It is a tool. The danger appears when every protection depends on the same forecast. The tenant is safe because AI demand will grow. The loan is safe because the tenant will pay. The collateral is safe because GPUs will stay valuable. The power project is safe because the data center will run at high capacity. One assumption supports 4 balance sheets. That is concentration disguised as diversification. Imagine AI revenue grows, but not quickly enough. Cloud providers reduce new commitments. Rental prices fall. Older GPUs earn less. Developers delay unfinished campuses. Asset values decline. Refinancing becomes expensive. Private funds mark loans down slowly because they do not trade every day. The crisis may not begin with a bank run. It may begin with a valuation meeting. There is also a credible, softer outcome. Demand could remain strong. New applications could raise utilization. Large tenants could honor contracts even if individual products disappoint. Older chips could serve cheaper inference workloads. Power-rich sites could retain value after hardware changes. Infrastructure can be repurposed. The future is uncertain, not predetermined. The most important signals are not dramatic model demonstrations. Watch contract concentration, debt maturities, interest expense, power commitments, construction delays, GPU resale values, lease guarantees, the gap between capital spending and cash generated from AI services. The boom becomes fragile when financing obligations grow faster than the revenue available to service them. Return to your electricity bill and pension statement. You may never invest in an AI startup. You may still finance the boom through retirement funds, insurance premiums, utility investment, or the companies inside your index portfolio. If the projected revenue arrives, those assets can produce decades of value. If it does not, the losses will not remain inside Silicon Valley. The AI boom is not built only on hidden debt. It is built on cash, public bonds, private credit, leases, joint ventures, and contracts that convert future demand into spending today. That machinery can accelerate real progress. It can also distribute risk until nobody sees the whole picture. The machines are visible. The promises financing them are not.